What's going on, guys? My name is Adam, and as I'm sure you can tell from the title of this video, we're going to be talking about two important profitability metrics known as EBIT and EBITDA. Just before jumping into the video, make sure you subscribe to the channel and that you have the notifications bell on so that you never miss an upload. So in this video, we're going to be talking about what EBIT and EBITDA are, what they're used for, what are the differences between them, and arguably most important, which one should we use. So let's get straight into it. EBIT, which stands for earnings before interest and taxes, is exactly what it says. It's a company's earnings before subtracting interest and taxes. Sounds pretty simple? Well, that's because it is. EBITDA, or earnings before interest, taxes, depreciation and amortization, is no different. It literally describes exactly what it is. EBIT is also commonly referred to as operating income, as it shows a company's earnings minus their operating expenses. Let's break EBIT and EBITDA down. Earnings is just the same as net income or profit, which is found near the bottom of the income statement. Before represents the fact that this is the earnings before the expenses of interest and tax are paid. Interest, which we add back onto earnings, is dependent on the capital structure of the company. How much debt has the company borrowed and at what interest rate? So the more they borrow and the higher the interest rate, the higher the interest figure on the income statement will be. Taxes, which are also added back to earnings, are simply how much the company has been taxed, which can vary across different countries. Depreciation is also added back if you're using EBITDA, and is a non-cash expense that represents the depreciation in value of tangible assets the company owns, such as machinery. Amortization, which is also added back to earnings when calculating EBITDA, is the cost of an intangible asset, such as a patent, and is usually spread out evenly across the lifetime of the asset. Now I know that's quite a lot to take in, so let's look at an income statement and see how this comes together. As we know, to calculate EBIT, we take earnings before tax and add interest to it, which, using the example here, we can see is equal to 51,400. To calculate EBITDA, we take EBIT and add depreciation and amortization onto it, which gives us 63,400. As you can see, using EBIT and EBITDA produce drastically different numbers, so never compare one company's EBIT to another company's EBITDA. Choose one metric and compare it exclusively. Now that we know and understand both these metrics, let's discuss the arguments for why one should be used over the other. People who use EBIT argue that depreciation is an essential factor that holds great influence over a company's net income, and therefore must always be considered. Value investors favour EBIT as it allows them to better analyse and find companies with a durable competitive advantage. For example, if one company can produce the same or a greater level of net income compared to a competitor with a lower amount of depreciation, it indicates that the company may have a competitive advantage over its competitor who requires more machinery to produce the same level of income. EBIT also allows you to focus purely on the operations of the business without taking any external costs into account, which allows you to gain a better understanding of how a company is really performing. On the other hand, people who favour EBITDA argue that because depreciation is a non-cash expense and tends to be spent on growth rather than just to sustain the business, it should be excluded when calculating earnings. And because amortization is for intangible assets and deemed unavoidable, it must be excluded for a fair earnings valuation. When a company is acquiring another in an acquisition, they tend to use EBITDA as chances are the companies pay different levels of tax, and the acquiring company might have no need for the machinery, which is why they exclude depreciation, and they may not need the company's brand, which is why they exclude amortization. But now we're going to answer a very important question that I'm sure you all have. Which one should I use? Well, it really depends on the industry that you're analysing. So in capital intensive industries such as the oil and gas industry, where depreciation and amortization are commonly very high, it makes sense to use EBIT as asset intensive companies are buying new equipment and machinery primarily using debt, and so their interest payments will be very high. Moreover, using EBIT allows you to analyse a company's operating performance and project it forward while stripping out the interest expense. However, if you were an investment banker working on a mergers and acquisition, you would be better to use EBITDA for the aforementioned reasons. What you'll find is that if you research both of these metrics, you'll discover that EBITDA is generally considered the weaker of the two, with even Warren Buffett disliking it. Buffett once said, "We won't buy into companies where someone's talking about EBITDA. If you look at all companies and split them into companies that use EBITDA as a metric and those that don't, I suspect you'll find a lot more fraud in the former group. Look at companies like Walmart, GE and Microsoft. They'll never use EBITDA in their annual report." So, take from that what you will. Others will also argue that because depreciation and amortization are not equal for all companies, it's essential that you keep them in when calculating a company's earnings. So there you have it, EBIT and EBITDA explained. As always, I really hope that you've enjoyed this video and that you've learned something new. If you do like content like this, consider subscribing to the channel, and if you have any topics you'd like me to talk about in future videos, put them in the comments down below and I'll try my best to get to them. Thanks for watching.